Okay, business acquisitions or exchanges here can be structured either as taxable or non-taxable. Now, at a taxable exchange, that's where the acquiree corporation or the seller pays taxes on any gains. Usually that's the shareholders or stockholders. And to the acquirer corporation or the buyer records the accounts bought from the seller corporation at a fair value for tax purposes and gets future depreciation and amortization deductions based on their fair value at the acquisition date. But there may be differences to account for between the tax basis and the financial basis. Now, with a non-taxable exchange, the acquiree corporation or the seller here defers taxes on any gains, and the acquirer corporation or the buyer bases their future depreciation and amortization on the book value or the tax basis for the accounts bought from the seller corp. And this leads to deferred tax assets and deferred tax liabilities that need to be recorded on the acquisition date. Okay, for a taxable exchange, the buyer records, depreciates, and amortizes here at the fair value of the assets and liabilities. And for a non-taxable exchange, the buyer records at the fair value here, but he depreciates and amortizes here at the book value. And then we have to be concerned with tax values at the acquisition. And just going through a simple example here for equipment, we have fair value was $145,000, book value is $80,000, but the tax basis here is $60,000. And then for our example here, instead of using the book value to determine our deferred tax assets and deferred tax liabilities, we're going to use the tax basis in this case. And you have to be concerned with that when you're doing these tax values here at acquisition. Now, the deferred tax asset and deferred tax liabilities, they affect the amount of goodwill for the acquisition and any amortization that's allowed for tax purposes here for deferred tax assets, deferred tax liabilities, or the goodwill here. And our example that we're going to be going through here will be for Corporation A, the buyer, and that will purchase here Corporation B, the seller, and it will be in exchange for stock for assets and liabilities. First, we'll calculate the deferred tax asset and deferred tax liabilities. Then we'll go through an example here for net operating loss carry forwards, and then 3 here, finally, we'll calculate goodwill in each of these cases. Okay, let's look at a non-taxable exchange here and determine our deferred tax assets and our deferred tax liabilities. Now, with a non-taxable exchange, that means that the book value will be used for taxation and the fair value will be used for financial reporting. And to determine our deferred tax assets and deferred tax liabilities here, we have set up a chart here where we've got our accounts listed here, and then we list the fair value for each of those accounts and our accounts here, and then we list the book value for the accounts, and then we take the difference between the fair value and the book value here, and we list the difference here, and then we have to determine the deferred tax asset or the deferred tax liability. And what we'll just take here the tax rate that we have here, and we're using 30% times the difference between the fair value and the book value here, and that we would list here as a deferred tax asset or a deferred tax liability amount. Now, to determine if it's a deferred tax asset or a deferred tax liability, we have to go through our little chart here. So I've got it set up here as where the difference equals either a deferred tax asset or a deferred tax liability. So if the fair value of the asset is greater than the book value of the asset, comparing the two here, then it's a deferred tax liability. And if the fair value of the asset is less than the book value of the asset here, it would be deferred tax asset. And then for our liabilities, it would be the fair value of the liability. If it's greater than the book value of the liability, then we have a deferred tax asset here, and if the fair value of the liability is less than the book value of the liability, then we have a deferred tax liability. So what I've made that comparison here between the fair value and the book value, and whether it's greater than or less than the asset or the liability amount here. And then we determined here that in this case it was I've got it listed here in red here, deferred tax liabilities here, and then we had a few deferred tax assets here. And then the total amount here was we have to record, because that's what we're going to use here to determine our goodwill here. And our total amount here was a minus amount or a deferred tax liability here of $115,000. Okay, to calculate our goodwill here for this non-taxable exchange, we'll look at our value analysis here, and I have a deferred tax liability set up here as under the liabilities account. So our fair value of our net assets, that would be the $860,000 for our total assets, less the total liabilities here of $255,000, which includes this deferred tax liability here of $115,000. So our net assets here are fair value of $605,000, and the price we paid here was $800,000 for the stock that we issued here, less the fair value of our net assets here of $605,000. So our goodwill here would be $195,000, and it's shown over here. Now to record this on our balance sheet, we'd debit or increase our goodwill here for $195,000, and then we'd have this deferred tax liability account here for $115,000. Okay, here we're going to be looking at the net operating loss carryover from the corporation that's being acquired. And in this case, Corporation B was being acquired by Corporation A, and Corporation B had an unused tax loss here of $200,000. So at the time of the acquisition here, we have to record a deferred tax asset here for this $200,000 net operating loss carry forward. But we have to set up here a contra allowance account for any unused or unrealized tax asset here. And what I mean by that is we can only offset this net operating loss carry over here based on the income that we're producing. So if we don't produce enough income for Corporation A here, we cannot use the total amount here of the net operating loss carry forward. So for our example here, we had this $200 net operating loss carry forward, and then our tax rate here was estimated at 30%. So our potential savings here would be 30% times the $200,000, or $60,000. So in our example here, we're saying that we're unable to use $20,000 of that $60,000 because we're not going to be able to generate enough income to absorb all of that loss. So our net operating loss here would be $40,000. So going down here, looking at our balance sheet here, we have a deferred tax asset recorded here of $60,000 at the fair value here, and then we have a $20,000 unusable amount here, which would be an allowance account for this deferred tax asset. Okay, now let's calculate the goodwill here, which includes this deferred tax asset. So looking at our value analysis here, our fair value of our net assets, for our total assets here we have $900,000. That includes this deferred tax asset here of $60,000, less the unusable amount here of $20,000. And then for our total liabilities here, the fair value, that's $140,000. So the difference here, $140,000, subtract that from the $900,000, and we have $760,000 for the fair value of our net assets. Now looking at our price that we paid here, that was the $800,000 worth of stock that was issued here, and then subtracting or looking at the difference here of the fair value of our net assets of $760,000. So the difference between the two gives us a fair value of our goodwill here of $40,000, and that's what we have recorded here on the balance sheet, that goodwill for $40,000. Okay, to record this deferred tax asset, we'd set up this deferred tax asset account here and debit or increase it here for $60,000, and then we'd have this contra account here, deferred tax asset allowance account here. We'd credit it or increase it here for $20,000, and then we'd record our goodwill here for $40,000, or we'd debit or increase our goodwill here for $40,000.